Limited Q4 and FY25 earnings conference call, hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star 10 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Tibrewal from Motilal Oswal Financial Services Limited. Thank you, and over to you, sir.
Thank you, Manav. Good morning, everyone. I am Abhijit Tibrewal from Motilal Oswal, and it is our pleasure to welcome you all to this earnings call. Thank you very much for joining us for the Five-Star Businessman's call to discuss their Q4 FY25 earnings. To discuss the company's earnings, I am pleased to welcome Mr. Lakshmipathy Deendayalan, Chairman and Managing Director, Mr. Rangarajan Krishnan, Joint Managing Director and CEO, Mr. Srikanth Gopalakrishnan, Joint Managing Director and CFO. On behalf of Motilal Oswal, we thank the senior management of Five-Star for giving us this opportunity to host you today. I now invite Mr. Pathy for his opening remarks. With that, over to you, sir.
Thank you, Abhijit. Good morning, everyone, and welcome everyone to Q4 and for the full year earnings call. I am happy to say we have done a commendable performance for the full year and in the last quarter. As I said in my last earnings call, financial year 25 was a challenging year, both from business and regulatory environments. We at Five-Star had forecasted well and done all the needed precautions. Our proactive decisions on growth and lowering the yields has helped us to navigate the tough times. Our focus was on quality growth rather than just growth. With this opening remarks, let me take you through the operational performance of Five-Star. We have opened 19 branches in Q4, and our total count stands at 748 branches as of 31st March. For the full year, we have grown from 9,641 crores to 11,877 crores AUM at 23.20%. If the disruption in Karnataka from January to March was not there, we would have done our guidance of 25% growth, which I said in last earnings call. Disbursement grew 9% year on year and 55% quarter on quarter, which indicates the business environment are better now. So we are back with quality growth. On collections front, our unique collections metric was at 96.2% in Q4 versus 96.7% in Q3, and collection efficiency was at 97.7% in Q4 versus 98% in Q3. There was a small dip due to disruption in collections in Karnataka from January to March. On NPA side, the gross stage 3 assets have inched up from 1.62% to 1.97% in Q4. Again, Karnataka has played a part on growing this NPA from 1.62 to 1.79. Having said that, but I'm very confident that this will get stabilized in this next quarter. And still I can say that we have one of the good asset quality for the profile of customers whom we lend, an average ticket size of between 3 lakh to 5 lakhs. We stand one of the best asset quality lenders in the entire country. On the cost of borrowing, our incremental cost of funds have dropped to 9.29% from 9.56%, nearly 27 bits drop This shows the confidence that lender has on Five-Star, and the rates are starting to come down. The cost of borrowing on the book is at 9.63%, same as last quarter. On profitability, I'm again happy to announce we have touched 4-digit profit after tax for the first time in the history of Five-Star. For the full year, we have done 1,073 crores PAT against 836 crores PAT for the financial year 24, registering a growth of 28%. To commemorate this achievement, the board also recommended a dividend of rupees 2 per share, which works out to 200% on face value and translating to a dividend payout of 5.5%, which is roughly around 60 crores on the total profitability of 1,070 crores. I would also like to assure that this would not have any major impact on our capital adequacy and our need for capital in the future. With this, let me close my initial remarks and hand it over to Srikanth for getting into more details. Thank you.
Very good morning to all of you. As Mr. Pati said, I think given the headwinds that we have been witnessing, our results are quite commendable. We have been seeing headwinds both in the form of over-leverage and also the disruption in Karnataka, especially in the last quarter. Given this context, and obviously the results will need to be looked at from this context, the results are definitely healthy and commendable. To get into some details, as of March 25, we had an active loan base of more than 4.5 lakhs. This represents a growth of 19% on a year-on-year basis in the borrower count. We ended March 25 with a branch count of 748 branches. We have added about 228 branches over the last 12 months. But this is largely due to the split branch strategy that we had undertaken, where bigger branches were split into smaller ones or newer branches from a risk management perspective. Disbursements saw a growth of 9% year-on-year and 55% on a QOQ basis. We consciously slowed down disbursements in Q4 to get to our AUM guidance of 25%. And this quarter we are back on track on disbursements. So the one quarter has not really had any impact on our disbursements. Our ability to pull back the disbursements has been demonstrated in the last quarter. AUM grew by about 23% on a year-on-year basis. If not for the Karnataka disruption, we would have definitely achieved our guidance. But again, like Mr. Pati said, I think we are an institution that focuses on quality growth and not growing for the sake of growth. We ended March 25 with an AUM of slightly short of 12,000 crores. We ended with 11,877 crores. From a yields perspective, our yields gradually keep coming down. As you would recall, we had dropped our lending rates by about 200 basis points for all incremental loans from November, which will have an impact on the yield. So for the quarter, the yield dropped to 23.7%. The spread remained healthy at about 14.1%. There was no movement in the cost of funds because most of the funds that we took, we had taken in the last week of March. So despite the incremental borrowing coming at a lower cost, this has not reflected on the book yet. But the good part is it will start reflecting on the book, resulting in better spreads. The NIM also dropped because of yield drop coupled with some increase in leverage. So the NIM dropped to 16.84% as compared to 17.19%. The cost to income, despite the headwinds that we are seeing, despite the credit costs that you see, our cost to income inclusive of credit costs still stands at less than 37%. It's at 36.63%, which is well within our guidance of 35 to 37%. It had inched up a little bit because typically in Q4 we also take some provisions for incentives for certain conferences that we will conduct for our employees. So given this, typically the Q4 expenses will tend to be slightly elevated. This has resulted in an ROA of 8.04% for the current quarter. ROE continues to remain healthy at 18.36%. From a borrowing perspective, we have about 47 lenders who have lent to us. what we had committed to you about 4 quarters back, that the company has been looking at diversifying its borrowing base, I think it's clearly showing very strong traction. We had dropped our borrowing from banks. The proportion of borrowing from banks has come down from almost close to 80% to 63% as of March 25. So we had about 63% of borrowings from banks. And in the last quarter, we had received incremental debt of about 700 crores. We availed about 1100 crores primarily on account of some older sanctions that we had. And this came in at an all-inclusive cost of 9.29%, which is 27 basis points lower than the cost of incremental debt that we had in Q3. We continue to carry good amount of liquidity on our balance sheet. We had a liquidity buffer of close to 2,300 crores and unavailed sanction lines of 100 crores as of March 25. The collection efficiency did drop a little bit, but if you look at it from a contextual perspective, the drop is not very material. There was a 30 basis points drop in overall collection efficiency and about 0.5% drop in our unique customer collection efficiency. There has been a slight increase in NPA from 1.62 to 1.79% on a quarter-on-quarter basis. Again, a slight inch up in the stage 2 assets as well. But what is also important to note is that we are carrying a healthy PCR on our overall book as well as on our stage 3 assets. Our stage 3 PCR remains at 51% and our overall PCR remains at 1.63%. So, given the situation, we continue to create appropriate levels of provisions on our books that can sort of insulate the company from any shocks in the future. All of this resulted in a PAT of 279 crores, representing a 18% year-on-year increase. For the full year, like Mr. Pati said, we have crossed a PAT of 1,000 crores, which is a really memorable achievement and an extraordinary achievement in the life of any company. We had a net worth of over 6,300 crores as of March. So I think we are very, we are very healthy from a capital perspective. There has been a little bit of asset quality impact, but if you look at it from a contextual perspective, I think we have delivered quite healthy results. What gives us confidence is the easing of interest rates, which will definitely mean lower cost of funds, the tax shocks that have been given for the middle income people, which means there will be more money in the hands of people for consumption as well as investment, which means our borrowers' businesses will go up. So I think this definitely should start, we should start seeing the demand picking up, which will result in a healthy growth, good asset quality and a strong profitability for the company in the quarters to come. So with this, we will end our remarks. Happy to take any questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets only while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Mahrukh Adajania from Nuvama Wealth. Please go ahead.
Yeah, hi, good morning. I had a couple of questions. Firstly, you did mention the impact of Karnataka on collection efficiency. So is that the only reason why your X bucket and even your total collection efficiency is lower QOQ? Is that the only reason, and how do we look at it going ahead, especially after the Tamil Nadu ordinance? So that's my first question, and then I have a few more questions.
Yeah, good morning, Mahrukh. Yes, you're right. The impact of Karnataka ordinance was completely unexpected. No one was prepared for that. So till mid of Jan, things were as normal. So by the end of Jan, the draft ordinance came into picture. And the ordinance were introduced in the February month that had an impact till 10th or 15th of March. So we have bounced back very well in the month of March itself, and this month we are bouncing back better. That is one major reason. The another general reason is the over-leverage crisis, which we have been talking for last 2 quarters, is still prevailing. It's not that completely they have gone. But I'm very happy to say that small ticket lenders, both from fintech and microfinance, they have stopped substantial lending to this segment. So the over-leverage, the threat of more over-leverage is gone now. That's why if you see our disbursement and business were back as usual. So I will say 2/3 contributed from Karnataka and 1/3 contributed in general.
Okay, so will that 1/3 ease anytime soon, or it will take time only?
As I mentioned in last earnings call, let me recollect what I have said is, I think the guardrails what microfinance and other small lenders have put in place has to come into act. I think I have heard something in last week saying that is deferred to 1st June or 1st July, whatever it is. So I think that is the first indication that the over leverage is completely stopped and over leverage comes down gradually. So I'm expecting at least from the June month or the July quarter, the small ticket lenders, unsecured small ticket lenders, they follow the guardrails what they have, the self-regulated organizations have been put in place. So I think that's the first indication I'll be looking very keenly. Second, I think since I have been saying that even though we lend between 3 lakh to 5 lakh ticket size, we are fully secured. So the behavioral aspect of customers remains completely different when they handle secured lenders. So I think we will be navigating this crisis with the healthy collections that has been shown on quarterly and monthly. So this will be prevailing for at least for next 2 quarters is my guess.
Okay, got it. And just in terms of your guidance, so now AUM growth will settle in the 25 range, or do you see it picking up to 30, maybe 2 years, because the size still remains low, right? So how do you view your...
So this year also, I think we are giving a guidance of 25% what we gave last year after October, till things get settled. So we have to see how the new Tamil Nadu ordinance, which have passed, but we are well prepared in Tamil Nadu. It's a home state for 5-star. We can handle any kind of situations here. And let me tell, till today morning, the situations are completely under control. There's nothing that whatever we have seen in Karnataka, nothing has happened till now. But this is a state of bigger banks and bigger NBFCs. I think state government will be very clear. And as I read the initial draft bill, the regulated entities like banks and NBFCs are completely excluded from this ordinance. That's what the bill said. We have to deep dive into the bill and see what are the implications. There will be some kind of disruptions, but not like what we've seen in Karnataka. That's the confident statement that I can give.
Okay, sir. And I have the last question. How do you look at cost of funds from here on, as in that when we build out for the future for FY26, we build and how much lower?
I think what is currently coming out is, especially the first repo rate cut that happened, there has not been much of pass on by the banks through lower MCLR. But after the second rate cut, we have seen banks already starting to drop their SAR rates, and deposit rates are also going down, which is a logical point for the MCLR drops to follow. So, and the other point is also that over the last few days, the expectation of the market in terms of interest rate drop during this year has gone up quite a bit. Originally, we were all thinking 50 to 75 basis points, but today I think people are talking a lot higher. So our belief is that on an incremental basis, we should at least see 25 to 30 basis points of benefit coming through to us. We also have about 65% of our book, which is variable rate, out of which roughly it is 50-50. MCLR link will be about 50% and EBR link will be about 50%. So even these should start getting, we should start getting benefits on reduction because of MCLR drops. So my sense is I think we should see a good reduction in cost of funds both in on the incremental debt as well as on the book in the next year to come. What is that proportion at this point of time? We'll just wait for banks to come down with their thoughts on the MCLR. But I think it should be a fairly sizable number is our hope and guess.
Okay, perfect. Thank you so much.
Thank you. We have our next question from the line of Raghav Garg from Ambit Capital. Please go ahead.
Sir, hi, good morning and thanks for the opportunity. Firstly, I just wanted to understand your thought process on the ECL provisioning. Stage 1 and 2 ECL provisions have come down despite stress rising. So I just wanted to understand that wouldn't it be prudent to provide more or create some overlays in such a scenario?
Raghav, we are creating good amount of overlays. The only point is, if you really look at our PD and LGD rates, these are fairly low. In fact, our LGD on one of our biggest segments will be sub 20%. So when you have a sub 20% LGD, that means you are effectively going to be creating only 20% provision on your stage 3 assets, right? But if you look at our stage 3, we are carrying 51% of provision. Obviously, we want to be conservative, and there is also some bit of input from the Reserve Bank of India on this, where they are sort of expecting the NBFCs to keep their provisions on stage 3 at around 50%. So a lot of our overlays actually go towards the stage 3 assets, which means you can't keep creating too much overlays on your stage 2 as well. But this quarter we have also created a good amount of overlays on the stage 2 assets, where let us say a 0 DPD customer at the beginning of the quarter did not pay any installment during that particular quarter. We have created an overlay on such customers. So there's a small portion of such customers because of the over leverage and Karnataka disruption we have seen during this quarter. So there we have created overlays. But given the low PD and low LGD, there is a little bit of a constraint in terms of creating too much overlays on stage 1 and 2. See, stage 3 is relatively easier because if there is a deep delinquent account, we can just overrule the LGD and create a 100% LGD on that. But that becomes a little difficult to justify when it is a stage 2 account. And in a stage 2 account, the proportion is also high. So you start creating an overlay, it adds to too much of provision. See, our belief is a provision of 1.5 to 1.7% is a very strong provision for a secured loan portfolio like ours. Now, how do you distribute this 1.5 to 1.7% is what the company takes a call in consonance with the board and the statutory auditors. So there will be some ups and downs that you will probably see in stage 1 or stage 2. But I think this is a consistent messaging that we've been giving for the last few quarters. In fact, last quarter also I said that we will be more focused on the overall provision coverage rather than nitpicking too much on what should be the stage 1, stage 2 and stage 3. Stage 3 is a little bit regulatorily driven. So we will probably maintain around 50% on stage 3. The balance will be given to stage 1 and 2.
Understood. That's fairly clear. The other question is, why has the ticket size gone up this quarter? Is that entirely an impact of low disbursements in Karnataka? And is that it, or there's something else to it? Because I think in last couple of quarters you mentioned that you'll try to contain your ticket size, right? So in that context, I just wanted to understand this a bit better.
So Raghav, the ticket size going up is a very conscious strategy. So we have been guiding over the last few quarters that in general, if you look at it, 5-star ticket size will be trending more towards 4 to 5 lakhs rather than being around 3 lakhs. Pre-COVID, we were about 3.5 lakhs, and we were guiding you that the ticket size will grow at least at an inflationary rate year on year. So more and more, I think the sweet spot for 5-star seems to be between 5 to 10 lakhs, rather than consciously focusing on very, very small ticket sizes of sub 3 lakhs. So sub 3 lakhs, also, this over leverage crisis exposed very clearly that people at sub 3 lakhs are the people and the vulnerable segments which got most affected because of the over leverage. So there is, conscious strategy at least on in terms of incremental disbursements. Can we move more and more towards little bit higher ticket sizes and thereby get the overall average ticket sizes up. So this is something that you will see trending in 5-star even in the future. I don't think we are changing our customer segments because even earlier we were present in this segment, but just that the importance and the focus that we are giving to this ticket size segment is a little bit higher than what we used to do earlier. So I think the average ticket sizes will tend to move up and go closer towards 4.5-5 lakhs as we see the in the next few quarters.
Understood. No, the only reason I'm asking is because there very specifically you had stated that you would try to control the ticket sizes until the situation is over. So should we understand that things are improving at a faster pace than what you had expected initially, and hence the call on increasing the ticket size?
Gaurav, what Ranga said is the profile of customers remains the same. But we have started to pick the higher category of profile of customers in last a few months. So if you see, the addition of number of customers or loans to 5-star stands at around 4% in last quarter, whereas the growth is at 6.25% in last quarter. Generally, if you see earlier quarters, both the numbers will go hand in hand. In this quarter, you see the addition of new customers to 5-star stands around 4 to 4.5, whereas the growth is around 6.25. That shows the ticket size is slowly inching up to the better profile customers in this segment. So it is not that what we said in last 2 quarters, increasing the ticket size of the same profile of customers to whom we have been dealing with, that we have still contained it, but we are picking the better customers in the profile of in the category where we lend. And we will be within the range bound of 3 to 5 lakhs. That is the sweetest spot of 5-star, where you see lesser competition and really it's a challenging underwriting and collections that has to be taken part. So there's no change in that.
Raghav, just one point to add in this is, as we reduce the interest rates, it's also helping us be that much more appealing towards this slightly higher ticket size segments and go focus towards them. So a combination of all this is helping the ticket size improve a little bit, as compared to previous quarters.
Understood. Okay, thanks. And do I have? Can I ask one more question, please?
Yes, Raghav.
Yeah. So any thoughts on pricing? This is a question that we keep getting very frequently. Any thoughts on reducing it further? Will you keep it here? I think not so much from a pricing point of view, maybe from a spreads point of view. What are your thoughts? I think right now you're lending at 22%, right? Any thoughts of reducing it further?
Raghav, in my initial comments, I said that proactively we have taken a call 2 quarters ago, reducing the rate of interest. I think that stands good for 5-star. I think we have brought down on a sizable and good from a lending perspective. I don't see we will be doing it, but as Srikanth said, we will be expecting the bank borrowing to come down in this quarter. As I said, comparing to last quarter itself, close to 25 bps have come down, incremental borrowing. Those incremental benefits, what we get from bank, I think we and board will take a joint call saying that how much it can be passed on to the new customers.
Thank you. That's all.
Thank you. We have our next question from the line of Aditya Pal Singh from MSA Capital Partners. Please go ahead.
Hi. Hello.
Yeah, we can hear you. Please go ahead.
Thank you so much. Great performance. Congratulations to the team. So quick couple of questions. When we look at the deterioration of the collection efficiency, so you highlighted in your commentary that some part of it was because of Karnataka ordinance and some part of it was because of cash flow problems or leveraging problems in some part of the customer base. So if I were to say it, is it largely the 70 basis points drop in our collection efficiency QOQ largely because of the Karnataka issue, or there is some fundamental underlying problem with the cash flows of our customers?
Yeah, Aditya, I recall what I said to the earlier questions is the drop in collection efficiency from 98 to 97.7. It is a drop of 0.3%, just 0.3% quarter on quarter. That's predominantly due to Karnataka's 2.5 months effect. It started in January, and now the normalcy is coming back strongly, but in March month we bounced back very well. So that is the 2/3 impact, and the balance impact is in general the stress in the system still prevails. It is not increasing, but still it prevails. So gradually you'll see some kind of collection dips here and there in some pockets from certain customers. So both put together only that 0.3% drop you see in collection efficiency comparing to last quarter. And that general trend, I think, will still remain in next 2 quarters. Not the Karnataka one. That is almost we are able to settle it very well. But the general trend in the system, especially in the middle and lower middle class profile of customers, will be there for next 2 quarters is my guess.
Understood. And just harping on the asset quality point again, if I look at all the asset quality indicators, be it stage 2, be it PAR 30 plus, be it a GNPA with 1-year lag and 2-year lag, there has been on last 4 consecutive quarters, we've seen it deteriorating. How much would you say that this is because of the problem in the microfinance and unsecured loan part, or I would say that the control that has happened, that is that the guardrails that have come in because of which the growth has slowed down in these pockets?
Aditya, our guidance, if you recollect our guidance for past many years, and when we become listed, we said our gross NPA will be sub 2%. Because please understand, we are not lending to the best of best profiles of this country. We are lending to a middle and lower middle class people where their underwriting is challenging and was challenging. As I said, even our asset quality has inched up to 1.79%. Still, I feel and I see, which is one of the best asset quality to the segment of customers whom we lend. So our guidance will be our stage 3 assets will be sub 2%. That's where our guidance always stands. Having said that, the overall credit cost, our guidance will be sub 1%. This is where the range that we like to operate. And as someone indicated, our lending rate is at 22% and our return on assets are at 7 to 8%. So keeping that in mind, asset quality at 1.77% is commendable position in the market.
Understood. And so just last 2 questions. So when I look at the branches, so in Q1 we had added, that is FY25 Q1 we had added 27 branches. What was the split branches in that part, in that number? And for FY26, how many split branches are yet to be completed?
So Aditya, just on an overall basis, if you look at, we are close to about 750 branches. Now out of the 750 branches, we'll have roughly about 150 branches which are split branches. Now majority of the branches which got opened last year we opened 228 branches, out of which 150 branches are split. We had explained this in the past, and I'm just reconfirming that.
Just wanted the data points.
Yeah, I'm just relating the strategy again. The first part of what we wanted to do as part of the split strategy is any branch which has more than 1,500 customers, we wanted to focus on them and then split it. That part of the split is largely over. Now we have a few more branches between 1,000 customers and 1,500 customers. This is a split that will continue to happen this year as well. But definitely it may not be as high as what happened last year. So in general, we are good to open about close to 75 to 100 branches every year, including the split branch. So I think we will stick to that same guidance as far as this year is also concerned.
Understood. And so, this in the balance sheet, there's a capital work in progress of 62 crores. And another last question would be that a new state has been added. If you can just help me understand these last 2 points.
See, the capital asset is a building that we had purchased, for construction of head office premises. So that will come up over the next few years. Because this is a place that we have purchased, you need to demolish the existing building and construct. So that is the capital work in progress that you're seeing there. I didn't understand. We have added the Gujarat state.
Yeah.
What is your question?
You wanted to understand which state. We have opened Gujarat. We have the first branch there in Ahmedabad.
Understood. Thank you so much. That's all from my side.
Yeah, thank you.
Thank you. We have our next question from the line of Renish from ICICI. Please go ahead.
Yeah. Hi, sir. Good morning, and congrats on the set of numbers. So just 2 things. One on the sort of clarification side, so I will take that first. See, in terms of this ticket size and all, at the of course, you did mention that 3 to 5 lakh will remain a sweet spot for us, given the kind of yield and with the credit cost. So on the suggested basis, obviously, this will be a profit driver. But when we are saying that incrementally sort of we move towards better quality and high ticket size, in the same customer segment to 5 to 10 lakh rupees. So how one should think in terms of AUM mix changing over the next 2 to 3 years, given there is a bit of a change in strategy. And obviously, 5 to 10 lakh ticket size segment is more crowded than, sub 5 lakh rupees ticket size, especially in TN when, even large NBFCs are also operating in same segment at 6-7% yield. So, so how one should think in terms of AUM mix changing, and also will this have any corresponding impact on the yields, which are at 22% currently?
Rinesh, so let me go a little deeper into it. As we stand today, the ticket size of more than 10 lakhs constitute close to 5% of our overall book. 5% of our overall book. And the majority of our book stands at below 5 lakhs. And some good amount of book stands at below 3 lakhs. What we are trying to do is, below 3 lakh segment, we are trying to be little careful in these times and start focusing on the ticket size around 3 to 5 lakhs more. So that is the first scenario. That is why you see the ticket size have gone up little 50,000 rupees from quarter on quarter. But having said that, what Ranga mentioned was we will be also focusing on above 10 lakhs cases, but not in a big way. Maybe the overall above 10 lakhs, which stands at 5% now, can go up to 7-8% in next 1 year or 2 years.
So Ramesh, just want to add, I think more than the focus that we give on greater than 10 lakhs, the focus will be a little more on 5 to 10 lakhs. So what you're seeing is about 13% of 5 to 10 lakhs today. That can even correct. So, what is sub 3 lakhs today, which is roughly at about 32%. If they are able to move about 5-10% of our book from less than 3 lakh proportion to 5 to 10 lakhs. So the way you probably look at it is less than 3 lakhs will be more around, let's say, 20% level. And more than 3 lakhs or 3 to 10 lakhs will be the large portion of our book. Today, you have 1/3 of our book in less than 3 lakhs. I think we want to cut that to maybe around 20% or 25% in the near future.
Got it. On the pricing side also, as we said, the yields drop, what we did 4-5 months back, that will also help us to get into a better ticket size segment. And more focus will be on 3 to 5 lakh segment. That will be the predominant book of 5-star.
Got it. So basically, we are not changing the strategy. Maybe given the current time wherein below 3 lakh is, appearing more vulnerable. So we are sort of changing that mix to 10% between 3 to 5 and 5 to 10. I mean, that's the fair assumption, right?
Yes.
Okay, got it. And now, so secondly, on this Tamil Nadu issue, and I'm just sort of drawing lines from the Karnataka again, how it impacted our book, right? So, given only 6% exposure in Karnataka, we saw at least a quarter facing a problem. And obviously, TN issue will be far lesser in terms of impact versus Karnataka, but at the same time, we are almost 30% in TN. So, how are you confident that Q1, Q2 sort of will be at par with your assumption in terms of credit cost and asset quality? Because when you are saying that we'll be able to maintain credit cost at 1%, essentially means that we are actually not factoring any of the issue from TN. So how one should read this?
See, as I said in earlier question, the Karnataka was completely taken by surprise. So that circumstance is not prevailing in Tamil Nadu as we speak now. So none of our employees from Tamil Nadu branches have reached out to head office talking about this bill. So that means it's very clearly contained, and people have understood that banks and NBFCs are excluded from this. But having said that, there will be some kind of pressure, little bit of disturbance at the ground level. We can't say there is nothing can happen. For that, we have to wait and see. Maybe 15-20 days from now can emerge as a clearer picture in Tamil Nadu rather than today. But my hope and confidence is Tamil Nadu is the home of many big lenders, both banks and non-banks, right?
Right.
So we are very acute here, and the connectivity, branch setup, people, all are well equipped to handle any circumstance. And being a hometown, that gives me a confidence that we can handle it far better than Karnataka.
Okay, got it. And so just maybe follow up on that. So maybe asset quality, collection, etc. might not impact and sort of span out as per expectation. But just the thought that, as a cautious stance, are we thinking to recalibrate disbursement in TN at least for Q1?
So as I speak now, we have not taken any decision on lowering the disbursement. The disbursement will be as usual in Q1 for Tamil Nadu. As I said, 15 to 20 days will give us a more clearer picture. If there is a need for that, definitely we will be proactive on that.
Got it. Okay. Well, sir, this is very, very helpful, sir. Thank you so much for giving answers. Thank you.
Thank you.
Thank you. We have our next question from the line of Viral Shah from IIFL Capital. Please go ahead.
Yeah, hi. Thank you, sir, for the opportunity, and first of all, congrats on, I would say, good set of results given the current environment that we are in. So I had a few questions. Just first, one follow-up to your comment with regards to yields, basically you taking into account whenever the banks pass on their benefit. Correct me if I'm wrong, but you had actually mentioned that you had proactively passed on this 200 bips of rate cut ahead of the, say, anticipated reduction. So with this reduction in cost of funds coming through, do we further anticipate, I would say, incremental yield lending rate cut over the next, I would say, 6-12 months?
So, Viral, I think what we meant as proactive was driven by us. But if you really look at our cost of funds, let's say 2-3 years back and where we were when we dropped our yields, it had actually come down from about 11.5 to 9.5. So there was a benefit that was required to be passed on to the borrowers. The only point was, given the uncertain times, interest rates were moving up, or rather they were not cooling off. You were seeing risk weights having an impact on possible capital and interest rates. So given the uncertain times, we had actually been pushing. But then when we were seeing that the regulator might step in or is getting a little uncomfortable with the kind of rates that entire NBFC industry was operating at, we proactively dropped the rates. So that is what we meant by proactive. Now we will definitely keep watching the space as and when we get a benefit that we believe is long-standing. See, in this segment, you cannot keep dropping the rates and then pushing up the rates for on a quarterly basis or on a half-yearly basis. Once you drop the rates, it has to be there for a long period of time. So when we believe that the benefit in cost of funds is long-standing and permanent for us, definitely on a proactive basis, we'll want to pass it on to the customers. So when we mean by proactive, it is not like at the instance of somebody. We want to do it on our own. So that's the intent. At this point of time, again, just giving you a little more clarity, we believe that the rates that we are operating at, and not just the interest rate, it's including the processing fees and others, what you call as the portfolio rate or the average annual percentage rate, APR. I think from what we understand is, we are at a range which is comfortable to the regulator also. So there is no additional action that is required from the company's end at this point of time. We will keep evaluating the spreads, and if we see that the cost of funds is dropping materially and in a long-standing manner, definitely we'll take the call to pass on that benefit. But our thought at this point of time is that maybe this may not be required for the next 3 to 4 quarters.
Got it. This is very clear. And just one more follow-up on that. Now that the regulator has again reverted the risk weight on bank lending to NBFCs, do you anticipate and want to say again go towards bank borrowings, given the advantage that it has being a floating rate book plus the relative ease of getting it?
Your point is valid. In fact, we had a fairly detailed discussion internally on this yesterday at our board meeting as well. So given that the regulator may not be too fussed about diversification, obviously internally from a risk management perspective, we want to keep a diversified borrowing book. So it's not like we are just going to go back to 80% of bank borrowing again. But yes, given that the regulator may not be too pushy, and the fact that it's a declining interest rate scenario, which means bank borrowings will come in a lot cheaper. The risk weight has not really had an impact on us. Even when the risk weight increased, we were able to push back any increases that the banks wanted. So I don't think that had any major impact. But with the interest rate cycle turning, definitely bank borrowings will be a lot cheaper. If you look at our Q4, where we had taken a lot of bank sanctions out of that, which is why you're seeing a 27 basis points drop in the cost of incremental debt. So given that perspective, I think we will want to be a little more, biased in favor of banks. So whether 63% proportion of banks will continue to keep dropping, it may not. Maybe we would like to operate at a 65 to 70% bank proportion, which will also give us a good benefit of the cost of funds.
Got it, Shrikant. And 2 more questions, I would say, for Mr. Pati or Ranga. If you can say, if we just take a step back from all of this crisis, maybe it will take another 2 quarters or 4 quarters, whatever it is. But does this structurally increase the TAM and the ability for us to grow, given the, relative pullback in the credit availability for those bottom of the pyramid customers? And are you seeing some of that happening already, given that we are all probably 12 months into the cycle? Just some from a medium-term perspective, any color you can give on that?
We are very optimistic on total addressable market. There's no change on that perspective. But if you see the lower middle class people where the leverage has gone up, I think fairly for last 6 months, the extra leverage is not building up. To that extent, the credit which was flowing very freely to them was completely pulled back, especially by the small ticket unsecured lenders, fintechs and microfinance. So that we are able to see from our new applications which we are receiving on a quarterly basis. So that is a very encouraging signal That is what I said. In Q4, the business environment is looking better, and this better will become better and better if you move quarter on quarter. But having said that, the guardrails what was being brought in by the MFI has to be implemented. If that gets implemented, two things will be positive for Five Star. One is the credit demand will be high because usually what they were getting from microfinance, the supply is now coming down, so that brings in a good quality of customers to pick and choose from even below 3 lakhs segment. That is one positive. Second thing is over leverage is contained. The cash flows remains healthy in the rural market. Our collections will be stabilized.
Got it. And on your comment, sir, with regards to the MFI guardrails getting implemented, has the 3-lender cap not been implemented? Because our sense was that it has already gone into effect from 1st of April.
No, I think as per my information, what I've been received a few days back, it's been pushed to June or July. But I'm not into that point because you have to check with the microfinance organizations.
Fair enough, sir. And sir, last, if you can just give some updates on our medium-term strategy to say getting into another product, say affordable housing. What is the thought process over there, or is it too early right now to discuss that?
I will not say it's too early because we have been discussing this product all the while. Because it's a 100% or more than that complementary to the existing product that what we have, mortgage loans to business and non-business customers. Definitely we will you'll see some kind of strides that we do organically in Five Star. Maybe we'll at least start up that initiative in the later part of Q3 or Q4 of this financial year to begin organically getting into that product with our existing branch network. As you see, we have close to 7,000 employees in business and collections and 750 branches network spreading across more deeper in South. So I think that gives us a easy runway to get into this product which we have been talking and thinking for a long point of time.
Got it. Sir, then when you do that, at least in the initial stages, I know you will be utilizing the same branch network and all, but it will require some bit of additional resources and processes to be there. Should we anticipate, say, some increase in your OPEX once you start that for, say, a year or so?
Viral, that is too early to answer that. You asked my thought process. I told you the thought process, how we will be planning at least the later part of this financial year. We have to look into it. So a lot of these things will be addressed at that point of time.
Got it, sir. Fair enough. Thank you and all the very best.
Thank you.
Thank you. We have our next question from the line of Madan Gopal Ramu from Sundaram Alternates. Please go ahead. Mr. Madan, are you there? Mr. Madan, are you there? We'll move on to the next participant from the line of Divyansh Gupta from Latent Advisors. Please go ahead.
Hi. One data point question. So what would be our non-collection employee count of that 6689? And the associated question is that if I look at per loan per business employee, at least in the last quarter, it was 1 loan per month. So does it mean that for any scale up, we will keep on increasing our headcount, or is there a headroom in increasing this productivity?
So let Srikanth and Ranga give the answer for the first one which you asked. On the second part, in general, when we move up to 12,000 crores of AUM, the general metric was per employee, the AUM will be around 1 to 1.25. That was our historical average. So we will be getting into that 1.25 crore AUM per employee. So that's our endeavor. That's also one of the reasons where the ticket size are moving up will help us to get into that 1.25 crore per employee zone. Comfort.
Yes, the total number of business officers alone at the end of last quarter was 4,889. So we also ended up disbursing last quarter 37,855 loans. So if you look at it on an average, every officer is doing about 2.6 loans per month.
Sorry, you said 4,889, right?
Yeah, 4,889 officers disbursing 37,855 loans, translating to 2.6 loans per officer per month. This is what happened in Q4. Yeah.
Got it. Understood. The second one was that in the last con call, someone had asked and you had mentioned that our average CIBIL score is around 550. Right? So if let's say I divide this into a spectrum of saying NTC and more than 650 and whatever remains else. So what would be that distribution, and is this a specific, let's say, underwriting policy, and is this a part of the strategy itself to target a lower CIBIL customer, because then other banks are not lending to him, he only has an option of going to a money lender, and therefore 5-star wins with its products and offerings?
Yeah, I think we completely new to credit. We have been telling in December broadly remains flat at what we have been telling is about 25%. You will probably see about 10% of the people, 10 to 15% of people who are at 650 and above, or maybe 700 and above. There will be at least 55 to 60% of our borrowers who are probably operating anywhere between 400 to 550 or 400 to 600. So see, the people who are, let's say, 700 and above, or those, they are being catered to by the larger NBFCs, banks. They are getting higher quantum of funds. They are getting cheaper funds. So that is not the target market for us. Our target market is either a person who is coming to the formal ecosystem for the first time for this size of loan. You could have borrowed a product loan like a microfinance or a gold loan. But for this size of a loan and a secured loan, we are probably the first lender to almost 90% of our customers. So we will continue to focus on this segment, the 80% being NTC and people with sub, let us say, 550 to 600 kind of a credit score. Because these are people where the target market is high, where we are able to command a slightly better pricing